Good morning. Welcome to the Daily Shareholder Brief. Today is February 18th, and we are looking at something important beneath the headlines: companies fetching AI premium versus software as a service companies repricing. This program is for informational purposes only and is not an investment advice. Always do your own research and consider your financial situation before making any investment decisions. Today we will cover six companies: NVIDIA, ASML, Intuit, ServiceNow, SAP, and Toyota. Let's start with NVIDIA. NVIDIA is a behemoth now. NVIDIA is now roughly a $4.5 trillion company. It trades at about 26 times forward earnings, and that multiple reflects extraordinary revenue growth, but it also reflects an assumption that AI infrastructure spending will remain structurally elevated for years to come. Here's the issue. At $4.5 trillion in market cap, NVIDIA is no longer priced for acceleration. It's priced for sustained dominance. The potential mispricing opportunity here is that if hyperscaler capex moderates even modestly, earnings estimates will adjust and the duration multiples compress quickly at this scale. The risk is not a collapse, the risk is normalization. NVIDIA reports its earnings on February 29th, so keep an eye on it to see how the hyperscalers' demand evolves. Our second company today is ASML. ASML sits at roughly $550 billion market cap, trading around 40 times forward earnings, and at a significant premium to its peers such as Applied Materials and Tokyo Electron. This is an extraordinary multiple for what is, at its core, a capital equipment company. However, the company recently reported strong Q4 2025 results on 28th of January, with a record quarterly bookings of around $13 billion, signaling robust demand for AI-related infrastructure heading into 2026. Yes, it has monopoly EUV technology. Yes, it has deep backlog visibility, but semiconductor equipment is cyclical. So the potential mispricing here is that the market may be pricing ASML as structurally insulated from capex cycles. Historically, that has not been the case. If AI-driven foundry expansion pauses, ASML feels it before the chip designers do. This is a premium industrial multiple, assuming structural rather than cyclical demand. Now let's move to the software sector. The first company we cover is Intuit. Intuit is approximately $105 billion company trading at nearly 16 times forward earnings. This is a dramatic reset from where premium SaaS company traded 2 years ago. Revenue is still growing double digits. Free cash flow conversion remains strong, but the multiple compression tells you something. The market no longer gives automatic premium valuation to recurring revenue. Potential mispricing opportunity here is that if the small business formation and consumer tax demand remains resilient, Intuit at 16 times forward earnings may actually reflect excessive pessimism. This is no longer priced like a growth darling it used to be. It's priced like a mature cash compounder. The second company in this sector is ServiceNow. ServiceNow is roughly $110 billion market cap, trading around 25 times forward earnings. That sounds reasonable until you consider it still trades over 60 times trailing earnings. ServiceNow assumes durable high teens to low 20s revenue growth. The enterprise IT budgets have held up, but deal cycles are elongating across the software universe. So if the revenue growth slips from 20% to mid-teens, the current forward multiple may prove optimistic. So this remains a duration asset, and duration assets reprice quickly when confidence shifts. Our next company in the software universe is SAP. SAP now carries a $240 billion market cap and trades at roughly 23 times forward earnings. The stock has declined by about 30% in the last year, including a recent decline of about 13% within the last month. While cloud revenue is growing, the company expects growth slowdown in 2026. The margins are expanding post restructuring and the installed base is deeply entrenched. Despite the recent sell off, the average analyst price target for SAP remains at $296. The investors may be placing too high an importance on deceleration of cloud backlog. And if SAP continues executing its cloud transition, 23 times forward earnings may underestimate the durability of its enterprise footprint. So, this is a lower duration risk but execution sensitive. Our last company today is Toyota Motor Corporation. Toyota, the world's largest automaker by volume, has a market cap of about $315 billion. And yet it trades at only 12 to 13 times forward earnings. Toyota's earnings have been significantly impacted by tariffs and rising costs, yet the stock has actually gone up by 25% in the last 3 months. This is mainly on the basis of better than expected earnings in the second quarter and an orderly CEO transition. Toyota generates strong returns on capital, benefits from hybrid dominance, and trades at traditional industrial multiple. Potential mispricing here is that Toyota's modest PE compared to, let's say, that of Tesla and its massive hybrid advantage presents itself as a potential mispricing opportunity. If hybrid leadership proves structural advantage versus aggressive EV spenders, Toyota's earnings durability may deserve a higher multiple. Right now, the market is assuming cyclicality and it may be underestimating the discipline that Toyota has. So, in closing, let's look at the spectrum of companies we've covered today. Nvidia, at 26 times forward earnings, is priced for sustained AI dominance. ASML, at 40 times forward earnings, is priced for structural capex expansion. ServiceNow, at 25 times forward earnings, is priced for durable enterprise growth. Intuit, at 16 times forward earnings, is priced for maturity, and SAP at 23 times forward earnings is priced for cautious transformation. And finally, Toyota at 12 times forward earnings is priced for cyclicality. The question for the investors is simple: where is the growth overassumed? Where is durability underappreciated? And where is duration being mispriced? That concludes today's daily shareholder brief. This program is for informational purposes only and is not an investment advice. Always do your own research and consider your financial situation and consult a professional before making any investment decisions. I may own some of the stocks discussed in today's briefing, and ownership could bias my interpretation, so please take that into account. Join us again tomorrow for another structured look at the companies shaping global markets.